Hey guys, welcome back to my channel. Today we're going to go through something interesting. I've actually taken new trades in the portfolio, as well as we're going to go through some key market events that you need to know if you're going to be trading the US stock markets. Right, so before we get started, I'll just trouble you to help me click the like and subscribe to the channel, as I'm going to be putting my portfolio for the scrutiny of the public. So I appreciate if you do just help me simply give a like and subscribe, as well as you'll get notifications whenever I post a new video. And some of these things are time sensitive, right? So we're gonna get to the main topic of today, and I'm gonna start by showing you my portfolio. Right. So if we look over here at the net liquidity, it's $50,300. So I've made $300 since starting this portfolio a day back. Of course, this is still gonna be going up and down. Not There's not confirmed that it's gonna be making money, right? So that relates to the trades that I've made, and I'll be sharing them with you right now. Okay, so I've made two trades yesterday. So if you look down over here at the finance instruments, I'm sorry if it's a little bit small, but if you can see here, I've made two trades, or there are two positions currently running on my portfolio. And the first one is $175 strike price cash secured put on Amazon, right? It's expiring on the 15th of November 2024. So that is 44 days. Okay. And this has yielded me, I think, $490. Okay. It's yielded me 499 $90 USD. And the second trade that I've taken is also same, selling a cash secured put on Google at 155 strike price, same expiry date in 44 days. And for that, I'm getting 353 USD if the contract expires worthless. So you might be asking, what is a cash secured put? So basically, a cash secured put, it means that I have the money to purchase Amazon, 100 Amazon shares for $175 per piece, and 100 Google shares for $155 per piece. So the reason why I'm doing this is because I feel that it is a good valuation, right? Um, for this portfolio, we're only gonna go with blue chip stuff, and especially if I feel that the valuation is right. Sorry, let me just correct myself. Majorityly is gonna be blue chip stuff. So I'm still gonna dabble a little bit of the riskier place, but it has to really warrant a good price before I'll enter those trades, right? Because the main objective of this portfolio is to generate some sort of monthly income, and that is the main aim of this portfolio, right? So that means that right now, 15,500 will go to Google if, let's say, I get assigned the shares. Assigning of shares meaning that the buyer of my put decides to cash in or to make me buy their shares. So if you record in the previous video, oh, by the way, if you haven't watched the previous video, I think it's an important video where I went through what are options and what are the risks involved in options trading. So options can be something that is risk low to mid risk as well as very high risk. So you got to understand that before you start trading options. So watch the previous video if you haven't. But today, uh, that means that I have 15,500 potentially going to Google if I get assigned the shares, and 17,500 going to Amazon should I get assigned the shares. But at the end of, so on the 15th of November, if the price stays above 175 for Amazon and 155 for Google, I'll just collect the premium. So remember the analogy where I was giving of an insurance company. So today we are acting on the part of an insurance company telling someone the right to sell us the stock should the price fall below the strike price. Right. So far it's going well. I think $300 in one day is pretty profitable. But we are yet to see, right, how this thing will go. Anything can happen in 44 days. But at the end of the day, what I want you to take away is that I am okay with buying Amazon at $175. I'm okay with buying Google at $155 because based on my valuation, I feel this is an undervalued stock at that particular price, right? So the next thing we're going to go on to is the SPY chart. So this is the S&P 500, the top 500 companies in the US markets, and it is an index fund, which is a safe financial instrument for you to put your money as well. Right. So let's just do some technical analysis on the charts, and then we'll go on to the market events later on. Right. So if you can look at this point in the chart, if you can see the crosshairs where I'm pointing to, um, this was the previous all-time high, right? And then we came down and we tried testing this area once again, but we failed to break out of it. And then we came down again, and on the third time's the charm, we successfully broken out of it. But if you take a look here, do you see something converging? So this is what we call support level. So the support level for the SPY is at $565, right? And currently we are coming down to test this area again, and I give it a 70% chance that we bounce off this level, right? And the markets will continue going higher. So yesterday we had something called the JOLTS announcement. The JOLTS announcement is basically the job openings in the US market. So let me just show you. For yesterday, okay, we have the JOLTS announcement if I can find it. 1 second. Right. Yesterday. Okay, there we go. JOLTS jobs opening. So these are the jobs opening in the US market, which I've mentioned. The forecasted was 7.64 million, and the actual numbers are 8.04 million. So this is kind of like pointing towards that the economy is strong. So what this is essentially saying is that companies in the US markets are open to hire more employees. And when they are open to hire more employees, that means that they see that they can deploy more capital to earn more profits, right? So basically, this is a good sign for the US economy. But you might be asking me, Daniel, then why did the stock market drop yesterday? Right? So to explain this, I have to explain to you the two mandates of the Federal Reserve. So in different time frames of the markets, certain news are more sensitive than others because everyone is looking towards those particular areas. And for the time ever since after COVID, the markets has really been focusing on the Federal Reserve's, their comments and their actions, right? So the two mandates of the Federal Reserve are to bring inflation down to a reasonable level and to keep the labor market healthy, right? So on the first hand of the Federal Reserve, they have been battling with bringing down inflation, right? This was caused by the huge amount of um, printing of money during the COVID phase. So They are trying to bring down the inflation rates, and recently we have just got our first rate cuts by 0.5%, right? It's actually quite a big step for the Federal Reserve to bring something down by 0.5%. Usually they will start with 0.25, right? So, what to tie that all back into this JOTS or jobs opening, this indicates that the market is strong. So this might send a signal to investors saying that, look, the Federal Reserve is going to have this data as well. And they're going to see that the economy is strong, and they might decide to, or not decide to, be so aggressive with their cutting of interest rates. And cutting of interest rates basically means that money will still remain expensive to borrow, right? So if you think about it in this way, as a company's perspective, if money is hard to borrow, that means that I wouldn't want to borrow so much money because it's going to cost me so much just to borrow this amount of money. So that's why you see the market take a dump downwards yesterday, because I feel that right now, what is important is that the markets want the Federal Reserve to come out and cut rates aggressively, right? So that was a lengthy explanation, but just keep in mind that the inflation rate should ideally be at 2%. So to understand inflation, inflation is actually not bad for the economy in general, right? If it's at 2%, it's a healthy range. So you want inflation to be going up at 2% per year. So again, as an investor, you need to think from the company's perspective. If inflation is going at 2%, that means that every year I can increase the price for my goods and services, right? So think, for example, Apple, right? They're selling their iPhones. Every year they are able to increase their prices, and that amounts to higher profit margin for them. So if the markets are actually deflationary, that is not good for the markets. It's good for a consumer because things are cheaper and will probably have a lower cost of living as compared to the current market conditions. But as a company, I don't want to be expanding in a market where I cannot price my goods higher each year, right? I cannot, companies are profit driven, so they think about profit first hand. So the magic number for the Federal Reserve is 2%, and they're working towards that, right? So just to summarize, is that inflation is not necessarily bad, but currently we are having a high amount of inflation, and that is making borrowing of money difficult or expensive, as well as raising cost of living for people. So as a whole, it's bad that it's this high up, but we want the Federal Reserve to be cutting interest rates all the way down to 2%, while keeping inflation at hand um, of 2%, right? Okay. So the next thing that we want to be keeping our eyes on is on Thursday, there will be unemployment claims. And then on Friday, there is also unemployment rates that is coming out. And of course, the non-farm employment change. Okay, so these three events are on the other hand of the Federal Reserve, right? So the first one is keeping inflation at 2%. The second mandate of the Federal Reserve is to keep the labor market strong. So these three events that is occurring Thursday and Friday pre-market opening is going to be important events to keep our eyes out on. So if the unemployment claims appear to be slightly lower than the forecasted, um, or yeah, lower than the forecasted, then that is a good sign for the markets, because that means that less more people have jobs and there are less people claiming for um assistance, right? Because they are unemployed. Right, and the unemployment rate, we want to see that coming down as well. That will be good for the markets in general. Um, so if we're seeing it at matching the forecast, right, the actual numbers are matching the forecast, I foresee that the markets will continue going up strong. However, if we see the unemployment claims coming way below the forecasted, um, that brings to the point again that the Federal Reserve might not want to cut so aggressively um, for the rates, right? So two things to keep in note. It's not good for the stock market if unemployment rate claims comes uh, very much less than the forecast. It also is not good for the market if it's too high. That means more people are unemployed and there is bad market outlook um, in the upcoming future, right? So the markets are tricky. You got to navigate it in a very you got to stay involved and to be navigating it closely, right? Okay, with that being said, I think we've covered the portfolio, the trades that I've taken, and the important market outlook that we have. So I'll just show you the income generating portfolio. There's not much data points, so as you can see, the chart is, just three data points, right? Because we just started on the 30th of September. So or in actuality, we started on the 1st of October. So yesterday I've logged in as $50,251. Today is $50,249. But as you can see, when I showed my portfolio earlier was 50,300. So this fluctuates um, on this end, right? But I want to bring your attention to the income generating portion, right? I'm sure we are all here because we want to learn how to consistently and safely earn income out of the stock market, right? So, as I've shown just now, $490 from selling that Amazon put and $335 from selling the Google put, right? So in total, that brings us up to about if my math is mathing, it's about 840 odd dollars. So if we convert that to Sing dollars, it's about $1,082 for 44 days. So how much does that translate to per day? 1,084 divided by 30. So that's $36 a day. So if we take $36 times 30, because we want to see how much we're getting. Oh, sorry, I think I didn't do the math correctly. Uh, 384 divided by 44. So that is about 24.6, right? 24.6 times 30. That gives us to $738 per month so far, right? So far based on the trades that we have taking. So I'm hoping to look for more opportunities to grow this monthly income. But so far we have already made $300 from the two trades that we're taking. And of course that is subjected to change. Right. So I'll be trying my best to come up with videos whenever I see opportunities in the markets. However, if you want to get more up-to-date or real-time updates on my trading portfolio, I also do have a TikTok, and you can follow me there because TikTok videos are short form, right? So they are a little bit more easier to handle. And I'll be posting there pretty regularly as well. And if you want more real-time updates, you can check that out. It goes under the handle RECD Stacks, the same as my YouTube channel. And with that being said, I think we have covered everything for today's video, and I'll catch you on the next video.